So today we're diving into something that's all over the internet right now. What stocks to buy and what stocks to sell. I've been reading through analyst reports, looking at articles from major research firms, and listening to the usual Wall Street noise. And yes, some of them are making very solid points, but most of it is hype. It's driven by fear, by FOMO, or by someone trying to get clicks. That's why today's video is different. We're going to look at 3 stocks that Wall Street believes might be worth buying, and also 3 stocks that Wall Street believes they might be worth selling. But here's the thing. We don't play that game. We're doing it the way real investors do it, by looking at the numbers, understanding the business, and figuring out the difference between price and value. Because guys, that's where the money is made. The difference between price and value. It's not about being first. It's not about being flashy. It's about buying a company for less than what it's worth and being patient enough to let the value catch up to it. Now, guys, this title, all the titles we do here are a way of getting people's attention to say, hey, what's going on here? And then in the video, we're here to teach principle-driven investing. We're here to teach a process on how to look at investments and how to understand them so you understand what you're buying. This is why I teach on YouTube. When I was younger, when I was following the hype, when I was following the news, when I was following the tips, I realized after I got burned that there had to be a better way. So when I learned a better way, I realized I've got to teach this out there. So if you're new here, I welcome you because you're going to hear me say things that you've never heard on YouTube before. That's really important to understand. This channel was created to teach. It was not created because some random video skyrocketed on some random stock I bought. I'm here to teach a process. So guys, let's kick this off with our first stock of the day, AMD. Now, I was reading an analyst report and it made a pretty interesting comparison. They said AMD today looks a lot like where Nvidia was just a couple of years ago. Think about that. Back in 2022, Nvidia's market cap was about the same as AMD's is right now. And since then, Nvidia has exploded because it's dominated the GPU market. These are the chips that are necessary for AI. I'm talking 85-90% market share. That's basically a monopoly. But guys, monopolies don't last forever. Intel used to have over 90% market share in chips. Markets evolve. Competitors adapt, especially when there's high margin. When there's high margin in a certain area, competitors will flood to it. And that's where AMD steps in. Ironically enough, the CEOs of AMD and Nvidia are actually cousins. So this is turning into a real family rivalry. Now, I am not saying AMD is going to dethrone Nvidia tomorrow. But if Nvidia just gives up 10% of that $550 billion GPU market over the next few years, and AMD catches that slice, guys, that's $55 billion in new revenue. $55 billion that Nvidia lost, $55 billion that AMD gained, a $110 billion swing. They've already partnered with OpenAI to supply computer chips. They're growing in their data centers, and their CPUs and GPUs are gaining major traction. The opportunity is real. But like always, we're not here to chase the hype. We're not here to just look at a story. We're here to figure out one thing. How do we value the company? And once we've valued it, is the price selling below value? That is our real goal as investors. That's the real goal of anybody who's a true investor. All right, guys, here's AMD. Here are some stats on them. Market cap of $417 billion. Guys, the reason this is interesting is one ratio I like to look at is price to sales ratio when looking at companies. Companies with very high margin and very high bottom line profit should have high price to sales ratios. Think Google, think Microsoft. Guys, Microsoft's profit is 30 to 35% bottom line and 70% gross margin. What that means on the gross margin is every extra dollar that Microsoft brings in, they are going to make 70 cents of that goes right to the bottom line before taxes and overhead. Their price to sales ratio is around 12. Guys, AMD is higher than that. But look at their profit margin, 9.5% versus Microsoft at 30 to 32%. Gross profit of 48% versus Microsoft at near 70%. So initially I'm like, seems a little expensive, but you got to remember, if a company has a lot of growth potential in its revenue and profit, it can justify a higher valuation, okay? Now, if this feels overwhelming, guys, you're not alone. But just hear what I'm saying here, and I'll repeat it, and you're going to hear it a few more times in the next companies we talk about. And as you watch our channel more and more, this will become more intuitive for you. So I immediately sit there and say, okay, it seems expensive here. Now, great growth rate. 11% a year on revenue for the last 3 years, 31% a year for the last 5 years, 20% a year for the last 10 years. And even better, not much in terms of acquisitions over the last 5 years. So they've done this growth organically by themselves. Now, one thing I don't like here, one sign of a great company is return on invested capital. And the reason being that metric says, hey, when we invest money into our business, we get a high return on that because there's debt and there's stockholders like you and I. We expect a certain percent return. Debt holders expect a certain return. Overall, 6%, 7% for debt holders, 10% for stockholders. But look at this company. They're not even making 4% in the last 5 years on their money, and in the last year, only 2%. That's not very good. That means they're not generating enough return on the money they invest in the business to pay and satisfy the debt holders and the equity holders, the owners of the company. That's not a good sign for a company. Now, no dividends paid, and look at these metrics. 100 times free cash flow, 147 times earnings. Now, the good news is their free cash flow is greater than their net income. I like that. That's very rare in a lot of companies these days, but I really do like that. And guys, in our community, the average rating is a hold. And this is going back about 6 months. And intrinsic value of $187 a share when the stock is at $255. So these are things to consider along the way. These are the main metrics I look at when looking at a company. Now, I made it easy for you. I made a cheat sheet that gives you all these key metrics on this page, tells you why they're important and how to think about them. So if you're interested in getting that cheat sheet so you can pay attention, understand, and in other videos, even with other YouTubers, you can sit there and look at the things that matter. Click the link below. We will email you that PDF 100% absolutely free. It'll be in your inbox within a couple of minutes, allows you to sit there and understand the companies further. Now, let's go to the 8 pillars. This is the things we have to ask. Now, there's 4 X's and 4 checks. Remember, if it's all checks, doesn't mean you buy. If it's all X's, doesn't mean you avoid. But here's the story I'm seeing. Net income growth, revenue growth, cash flow growth. One thing I like, the cash flow growth in the last 5 years is greater than net income growth. Things I don't like. Another thing I love, low debt. They can pay off all of their debt, all their long-term debt with 2 years of the last 5 years of free cash flow. That's awesome. So imagine you at home. You have a mortgage, you have car payments, you have student loans, and just using 2 years after all your expenses, you could pay off all your debt. How amazing would that be? That would be awesome. And again, we're back here to the valuation front. 160 times 5 years free cash flow, 195 times earnings. But guys, here's the one that not many people talk about. Shares outstanding are up 32%. This is dilution. So, not only is this company getting low returns on the money they invest in the business, you as an investor, they've diluted you. What does that mean? If a company has 10 shares outstanding, you own 1, you own 10% of the business. If they add 2 more shares, you still own your 1 share, but now you're splitting all the revenue, profit, and cash flow amongst 12 people, not just 10. So you went from 10% ownership to now 8.33% ownership. You got diluted. I don't like that. And I get why AMD does that. Their stock is probably overpriced, so they're going to take it for a ride and say, listen, let's issue shares like crazy. Let's get that cash in because we don't have to pay it back. So I get that. That's a big reason why their returns on capital are so low. Now, guys, in just a few minutes, I'm going to get to the stock analyzer tool where we're going to figure out the right price to pay. But before we get there, let's go look at analyst estimates. Guys, they have amazing growth in their earnings per share according to analysts, going from $4 a share to over $10 per share in the next 4 years. That is massive growth according to analysts. Revenue, also massive growth. $33 billion to $61 billion, almost doubling. 29%, 21%, 18%, 23%, 3.5%. Look at all this data here readily available for you. So this is what I always tell people. You have some numbers. You have a story. We got to put it together. That's why we have the stock analyzer tool. This is the reason why this tool is the most popular of all the tools on our software, used over 1 million times per year by our users. It allows us to marry the story with the numbers. And what I always tell people is do a quick look at the numbers and then go to stock analyzer tool immediately. And the reason being is I don't want you wasting your precious time. Go put in reasonable assumptions here. And you'll learn to do that as you talk to other community members and watch more videos. And once you do that, you'll be able to see if the stock is even remotely close to what you think it should be selling for, and therefore spend more time. Or if it's too far away, just move on and wait, put it to your watch list and wait until it gets closer. So let's go pull up the last time I did AMD. Let's see, only a couple of weeks ago. I did big revenue growth assumptions. I wonder if I did something that day a little bit. Okay, so here's what I did. I did a 10-year analysis, and I did 8, 16, and 24% revenue growth. That's a lot. That's okay, though. Profit margin, I did 8, 15, and 22. What I did here was, even though they've never done 15%, keep in mind, I put middle assumptions in here that they've never done before. So I'm being very aggressive. I remember what Intel used to make when they were, even a few years ago, they were making 22% margin, bottom line margin on their products. Now, what's the right PE and price to free cash flow? Well, I always tell people, start at 15 or 16 and go higher for good companies, lower for bad companies. Now, this is a little confusing. The last 10 years, their return on capital was negative, 7.5%. Last year, it was positive. So they're trending in the right direction. They have a lot of growth potential. That's a positive sign. They make a great chip, another positive sign. So I sat here and put 18, 21, and 24. I think that's a little high, but I want to put that in there just to see, okay, when we're looking at this company and it's selling for so much, let me give it a lot of momentum behind it to see if it's even worth the time. And finally, guys, my desired return, I only put in 9%. The reason being is I want to find the intrinsic value. What's the company worth? But remember, don't buy based on 9 or 10% for a stock, in my opinion. The reason being is you can get that from a low-cost ETF. If you're going to own an individual stock, have margin of safety in there. Have a higher return. But either way, I'm going to sit here. I'm going to hit the Analyze button. The stock is currently at $255. Guys, I have a low price of 36, a high price of 420, a middle price of 140. So guys, if it hits home runs and does all of my high assumptions, according to my discounted cash flow model, I'll make about 15% return. But if it doesn't, guys, the returns really suffer. So you have to ask yourself, is it more likely that they kill it and hit my high returns, or more likely to hit the low returns? For me, and I'm looking at this 140, I'm just going to stay patient. For me, I look at it going, it's not for me right now, but that's my opinion. Now, what are these analysts thinking? Well, they look at this and say, Nvidia is matching this. Well, Nvidia made a lot more money than AMD did at the same market cap. It wasn't as overpriced. That's what people don't remember. It's amazing to me that people always ignore the most important metric for all companies, and that's valuation. That's what's incredible to me. Most investors are going to lose money because they're trying to pick the next winner. Hence why people talk about AMD being exactly like Nvidia. But the best investors, they do the opposite. They eliminate the losers first. That's what we do here. And we analyze the stock in looking at the data and on Stock Analyzer. But you've got to remember one thing. The most important metric is valuation. And there is no set valuation. It all depends on the future growth of the company and its earnings. So a company that's growing 20% a year should get a much higher premium than a company that's growing 5% a year. So that's why I think AMD deserves a premium. But even using our model here with the premium levels everywhere, it's still not looking like it's an obvious buy to me. So on the tail end of our first buy, let's talk about our first sell stock of the day. You ready? Nvidia. Now, you've heard the hype. You've seen the headlines. AI king, unstoppable growth, buy at any price. But when I dug into the analyst commentary, especially the piece from Bloomberg, one firm stood out as a total contrarian. Analyst Jay Goldberg has a sell rating on Nvidia. He's staring the entire AI frenzy right in the face and saying, this is not my first bubble. He argues that while everyone's cheering Nvidia's growth, which they should, the valuation is already so extended that the what ifs far outweigh the ifs. What if chip demand slows? What if AI spending comes in lower than expected? What if the massive market share and price hikes are already baked in? What if they lose the massive market share and price hikes, even by a little bit? So for you, the investor who's trying to build real wealth, not just riding the latest trend or wave, you need to know this. A stock can be great, But if you overpay for greatness, you lose margin of safety and you'll likely lose money. When the hype fades, as it always does, you're left holding a stock whose value might not match what you paid. Because remember, our fifth tenet of our principle-driven investing is probably the most important one. A great story becomes a bad investment if you pay the wrong price. I pound this table because it's the most important thing you need to learn. Because in the world of hype and FOMO, they're focused only on a story. To which I say, great, add a couple zeros to the price. Your story and your thesis stays the same. So what that means is no price is too high. The same, take a couple zeros away. Doesn't change. It's ridiculous to think that way. But that's what people are saying when they only follow the story. You are going to do better than that. You're going to follow the story, the price and the value together. That's how you'll make the right decision. So let's check out Nvidia and do a same key metric breakdown of Nvidia. So guys, Nvidia, if you remember AMD was selling for 14 times sales, Nvidia is selling for 30 times sales. $5 trillion market cap, essentially. Revenue of $160 billion, net income of $90 billion, free cash flow is huge. Returns on invested capital absolutely crush AMD. 5 years ago, the last 5 years, it was 26%. Last year, 50%. These guys are much better at getting a high return on the money in their business than AMD. Far, far better. Growth, 77% a year for the last 3 years, 66% for the last 5 years. Increasing margins, 70% gross margin. Remember, 70% gross margin. It was 48% for AMD. Profit margin, 52% here. AMD was 10%. Do you see the difference here, guys? This is a far better company financially. Far better than AMD. Like, not even close. Do you hear what I'm saying here, guys? I am sitting there looking at a bear analyst saying this stock is overpriced, and I'm giving you all the positives to it. Because guess what? A great story can have bad numbers. And a bad story can have good numbers. These are all the ways I want you to look at this. This company is wonderful. There's no denying that. Does it deserve a premium? Absolutely. How much of a premium? Well, I'll tell you right now, our community has it as a hold with an average intrinsic value of $128 a share. But we'll get to that shortly. Let's look at the 8 pillars here. 6 checks, 2 X's. 2 X's, valuation. Basically the same as AMD over the last 5 years. But 69 times last year's free cash flow, 57 times last year's earnings. Their free cash flow is lower than their net income, but I think Nvidia has more capital expenditures they're increasing. We can look at that later, but that's really important to understand. Analyst estimates. Guys, $3 a share, growing to $9 a share. That's 3x over the next 5 years. That's big time growth, guys, if they're right. Revenue growth, wow. 132 billion growing to 391 billion, another 3x. I'm actually surprised analysts only have their earnings up 3 times when their revenue's up 3 times, because when you have a high gross margin, you can really add a lot of money to that bottom line. That doesn't make sense to me that based on $391 billion, yeah, they should be making a lot more than that. But either way. Okay, now guys, let's go to Stock Analyzer. Let's pull up Nvidia. I remember the last time I did Nvidia, I did very, very, very rosy assumptions, in my opinion. I did a 10-year analysis, 10, 15, 25% growth rate, profit margin and free cash flow of 35, 40, and 50. I went higher on the high end, PE 18, 22, and 28. Keep in mind, I assumed that this 50% margin is not going to stick around for very long. They'll get more competition. AI might slow down, etc. And I did my 9% desired return, hit the analyze button. The stock's currently at 201. Guys, I have 68 on the low side, 435 on the high side, 133 in the middle. So is the juice worth the squeeze? Guys, the reason I'm saying avoid the stock is it's pricing in perfection. And it feels like perfection is going to happen. But there's a reason why one of the most common questions we look at in the community and even on YouTube is, when should you sell a stock? Well, it's simple. If the reason you bought it turns out to be wrong, you sell. I've done that before. I bought a company going, oh boy, I was wrong, sell. Another reason to sell stock. I've said this before. This is my opinion. If you sell the stock, calculate how much you're going to pay in tax. Deduct that from your investment. If you'd still buy the stock at that price difference, for example, you own a stock at 200. If you were to sell it and taxes would be $60 a share, you're at 140. If you would buy the stock still at 140, then I say keep it. If you wouldn't buy the stock at 140, maybe you should sell it. But most importantly, sell it if you have other opportunities that are far better. Because remember, your job is to allocate capital, put it in the best opportunity. If you have a situation where the potential return on a stock is 5%, you have another opportunity where it's 15% a year, yeah, you need to put that money towards the 15% stock. Now, it all depends on your personal preference. Some people, if your stock runs up too much, it's too much of your portfolio, maybe you sell. The key is understanding what the company is worth. Monish Pabrai says it best. There are 100 reasons to sell a stock, but only one reason to buy. You're going to make money, usually because the stock is undervalued. That's why understanding valuation matters. Don't buy blindly. Know what it's worth. All right, guys. Now let's move to stock number 3. This one comes with a buy rating from Investors Business Daily. We're talking about Google. So here's the story. According to the Investors Business Daily article, Google isn't just a search engine anymore. It's becoming a major player in AI, cloud computing, and deep tech infrastructure. They're investing billions to build out their AI chips. Their cloud services are growing fast, and their ad business is not just strong, it is still booming. This means Google has multiple ways to win, not just one. In the principle-driven mindset, that's exactly what you want. A business you understand, a clear way it makes money, and room to grow. Google ticks every single one of those boxes. But as always, we need to see where the difference is between price and value. So here's Google's metrics. $3.4 trillion market cap. Look at this, guys. 8.9 times price to sales ratio with Microsoft type profit margins, 32% last year. Gross margins of 60%. So this is awesome. Their growth rate, 11% a year for the last 3 years, 17.5% for the last 5, 18.5% for the last 10. You've got great returns on capital that are getting better. 15.5% essentially. They have this adorable little dividend. But guess what, guys? That 0.3% dividend still eats up $10 billion of their cash flow because of how valuable the company is. So you've got to remember that. Now, when we do our stock analyzer tool, you don't add this dividend to the returns there. That's included there because it's a discounted cash flow model. It doesn't care where the cash goes after. It's just whatever cash is coming into the business. All right, let's check out the 8 pillars. Just like Nvidia, we have 6 check marks, 2 X's, valuation front. But these 5-year PEs and price of free cash flow are much lower than Nvidia. We have 50 times free cash flow, 40 times PE. And in the last 1 year, their price of free cash flow is 46. Okay, seems pricey, but again, we have to understand what the growth potential is. Well, this is what analysts think. $10 a share this year, growing to almost $18 a share in the next 4 years. That's pretty good growth. And revenue growth, double digits. $400 billion growing to $610 in the next 5 years, double digits per year. So this company, for how big it is, still has a lot of growth potential. And that's when we go right to our stock analyzer tool, pull up our Google, and see what assumptions we made. 10-year analysis. Now, I might be conservative here. I did 5, 8.5, and 12% revenue growth. You know what I'm going to do here? I'm going to make it 5, 9, and 13. Profit margin, I did 23, 27, and 31. And PE and price of free cash flow, I did 18, 20, and 22. Guys, I actually think that's low. I think Google deserves a higher than this PE and price of free cash flow. They own the 2 largest search engines in the world, Google.com and this very channel you're on, YouTube. Google is a verb. You go everywhere for YouTube. You go everywhere to learn. It's absolutely ingrained in our life. That deserves a premium. I can understand if somebody went higher than these numbers. And finally, a 9% return. The stock's currently at 280. Hit the analyze button. Guys, we got a low price of 155, high price of 471, middle price of 273. So it is reasonable from this perspective on the middle cases. But remember, are you only looking for 9% return? So I have it on my watch list for 200. And the reason being, if it falls down there, it'll notify me on the software, on an email, and I'll be able to go in there, run my numbers again, and see if I'm interested in buying it at that current price. Guys, I have felt that panic in my gut as well. When stocks fall, fear takes over. You start thinking, do I sell before it gets worse? I've been there. I've made those emotional decisions and I paid heavily for them. But patience and planning are what separates principle-driven investors from degenerate gamblers. Once you understand value and how to determine it, your perspective completely transforms. Price drops become golden opportunities, not disasters. That's what we teach at Everything Money: how to think long-term and stay calm when other investors start losing their minds and they dig holes that kneecap their financial future. Get access to the tools and the knowledge that protect your portfolio and your future from those emotional decisions that will destroy wealth. Start your 7-day trial right now. Guys, our next stock with a sell rating comes from Forbes. And honestly, this one speaks my love language: valuation. They're talking about Costco, one of the best run retailers in the world. Great business. That's an understatement. Phenomenal business. Loyal customers, consistent profits, and from what I understand, hell of a hot dog. I've never had it, by the way, but I still need to do that. But here's the issue that Forbes points out: it's priced like nothing bad can ever happen. The stock trades at a huge premium compared to its historical average. Now listen, I love Costco's business model. It's stable, it's predictable, prints cash flow. Every parking lot at Costco is absolutely jam-packed. But the price you pay matters. If the stock is already pricing in years of perfection, even a small slowdown can hit hard. This is what I mean when I say great company, bad price. Valuation is the difference between investing and speculation. If you buy even the best business at the wrong price, you will have bad returns. The other thing is, the stock has become very internet famous because Charlie Munger, Warren Buffett's right-hand man, has said he would never sell his Costco shares. He is dead now, but he always said he would never, ever sell his Costco shares. He said he's never seen a company that cares about the customer as much as they do. I think it's become this sort of like, if Munger loves it forever, I'm going to love it forever. But let's break this thing down because it's very important to understand this company. It is a $400 billion juggernaut. They do $275 billion in revenue. Their price to sales ratio is 1.5. The other companies we were talking about were 8, 9, 10, 12. But here's why. Their profit margin is under 3%. Costco is notorious for only marking things up 15%. They take their costs at 15%, put it on the shelf. That's a very common thing. They pay a dividend, small dividend, but this is what I love about Costco. They pay the small dividend, about 0.5%. But every few years when they get their cash up, they pay a one-time very large dividend, $20, $30 a share. I like that a lot for a company. Don't commit to this repeated dividend that everybody falls in love with and attaches themselves to. Now, what's interesting here, our community also has this to hold. They have an intrinsic value of 478. Where's the stock currently? 931. But here's what's also great. Look at these returns on capital. And you better believe a company that Charlie Munger would love so much would have high returns on capital. So this company is phenomenal and very low debt. $412 billion market cap, 445 enterprise value. That difference is essentially their debt. So for a retailer to have that little debt, that's pretty impressive. Charlie Munger loved this company for a reason. Let's look at the 8 pillars here. All right. They've increased their business barely. This should be a green check mark. It doesn't really matter. They're barely up in shares outstanding. Everything else is green, but here's the interesting part, guys. Huge price to free cash flow and PE ratio. Just nosebleed. Their 1 year price to free cash flow is 53. Their 1 year PE is 51. Guys, for a company that makes 3% and won't grow a ton, that's kind of disturbing. Look at the analyst estimates. Earnings per share growth. 11%, 10.5%, 10, 9, 5.5%, 18.5%. That's good growth, but it's not nosebleed growth. And revenue growth, this includes opening more stores. Mid to high single-digit growth on revenue. So not some big grower. And remember, at 3% bottom line margin, it's not exactly this amazing, awesome company that you have to pay some huge premium for. But again, we got to put the numbers and the story together. Stock analyzer tool, pull up good old Costco. Guys, I did 4, 6, and 8% revenue growth. I did profit margin of 2.5, 2.75, and 3. Now you can see here in the last 10 years, their profit margin is getting better, but I still kept it there. PE, 18, 21, and 24. Guys, I'm going to give them a little bit better. 19, 22, 25. They deserve that premium. And my 9% desired return, hit the analyze button. The stock's currently at 930. Guys, look at this. The low price of $295, high price of $583, middle price of $416. This phenomenal company, if you paid today's price and the middle assumptions occur, you'd have a negative return over the next 10 years. That's the thing you need to understand completely about this company. Guys, let's keep it rolling with our third stock to buy. And this one comes from Zacks, who just named Adobe a top long-term growth stock. And guys, guess what? I own this company. Don't go buying it because anybody on the internet or even Warren Buffett or Charlie Munger own it. We're here to teach a process so you can fish yourself. I get it. Adobe isn't flashy like other AI chips or electric cars, but here's what Zach sees, and frankly, so do I. Adobe's got deep roots across creative software, marketing tools, digital documents, and they're expanding those into the AI space without betting the farm. They've got consistent revenue growth, high margins, and they turn free cash flow into profit much better than their actual net income, and they're buying back shares. That's real shareholder value. When you buy back shares at the good price, that's when you're building shareholder value. Zacks points out that Adobe's strong earnings outlook and return on equity, both signs of high quality, efficient businesses. Now, doesn't matter. We still need to watch for valuation, as always. I bought Adobe when it was a no-brainer and I watched it run up and said I wouldn't buy more. But as it falls, I buy more. If Adobe continues to dominate its niche and grow its AI-powered tools, this could be a long-term compounder. Great business, growing cash flow, strong execution. What else do you need? That's the recipe we like and we need for a great company. So let's go pull up Adobe. So Adobe, $142 billion market cap, generates $10 billion a year in free cash flow, has returns on capital, 22% a year for the last 5 years, over 30% last year. We actually have a buy rating from the people in our community with an average intrinsic value of 450. That's what I love about this metric, this software. It allows people to vote on this stuff. Bottom line margin of 30%, gross margin of 90%. It's the highest we've seen so far. Every extra dollar they bring in revenue, 90% of it goes to the bottom line before taxes and overhead. Very little acquisitions, but solid growth rate. Guys, what else do you want from a company? What else do you want from a company? 8 pillars. Well, like I said, their free cash flow is greater than their net income by a lot. 9.6 billion versus 7 billion. So it's skewing this PE ratio. I ignore that. To me, this is basically an 8-pillar thriller. Let's go check out the analyst estimates. $21 a share, growing to $30 a share in the next 4 years. Double-digit growth on average. And revenue growth, high single digits. 24 billion going to 33.5 billion. 10, 9.5, 9.5, 7.5, 8% revenue growth. Guys, this company is selling currently, look at this, for 15 times free cash flow. How many companies can you see with 90% gross margins, 30% bottom line margins, almost double-digit growth in earnings and revenue on the forefront of artificial intelligence and software? And they're able to buy them for 15 times profit. So, free cash flow, I mean. Let's pull up Adobe in our stock analyzer tool. So guys, I did 4, 7, and 10% revenue growth in the next 10 years. I'm going to focus on free cash flow here. Look at their history. It keeps getting better. 38%, 39%, 41. I did 38, 40, and 42. What PE and price of free cash flow? I put 18, 21, and 24, which I think could be justified higher, and my 9% return. The stock's currently at 335. Hit the analyze button. Low price of 380, high price of 820, middle price of 560. Guys, I think this company, the juice is well worth the squeeze. But again, do your research. This is a company that justifies doing research on, because you look at this and say, oh my gosh, we have 3 green numbers here. That's incredible. This is the kind of company you want to pay attention to. Now, third stock to sell. Palantir just reported, and they reported a great third quarter. Revenue beat expectations. Profits look stronger. They beat expectation. The company's been shouting AI from the rooftops. So why are some analysts cautious, even pulling back? Well, according to Seek and Alpha, which we have right here, the concern is simple: valuation. The stock is priced like everything's going to go perfectly and that the recent growth is going to continue on for perpetuity. And when a stock is priced for perfection, there is no room for error. The company is still growing and growing massively, but the pace is slowing slightly, and keeping up that level of long-term growth is going to be a challenge. I don't care who you are. That's where the risk creeps in. At Everything Money, we always ask, does the price make sense for the value? And right now, with Palantir, the numbers don't give us enough margin of safety. You've got to remember here, Michael Burry, yes, I know, he's been a little off lately. I love the fact that I'm in his same shoes, but he's short Nvidia and Palantir both. But let's go look at the valuations here. Guys, first off, it's a $500 billion company that people are pricing in like it's going to grow 30% a year. That's very difficult. Look at this, price to sales ratio of 143. We have a record of all these 6 stocks we just did, 143 times price to sales. Great gross margin, 80%. Guys, don't even look at their profit margin. You know why? Their free cash flow is much greater than their profit. I'm focusing on free cash flow, just like an Adobe. I'm focusing on free cash flow. Barely any acquisitions, and look at this growth rate. 25% a year for the last 3 years, 30% a year for the last 5 years. Their return on invested capital went from negative 14% to a positive 5%, which means it's getting way better. I love that. 8 pillars. Not as bad as I thought it was going to be. Basically, no debt in the company. Revenue growth, net income growth, cash flow growth. But look at these absurd numbers. And they're diluting people. 35% more shares this year than 5 years ago. Now, let's look at analysts here. Analysts have the company going from 65 cents a share in profit to $2.24 in the next 4 years. That is big time growth, well over 30% a year. Revenue growth, 48, 37, 33, 45, 33. Big time growth. Now, while the analyst rates Palantir as a stock to sell right now, that doesn't mean it's a bad company. Far from it. In fact, there's a very specific price I'm waiting for Palantir to hit before I buy a whole load of the stock. Click on the video on the screen right now, because in it, I will tell you exactly what the specific price is and why it'll trigger a big buy from me. Trust me, once you see the data, it might pique your interest to do more research. Thank you for your time.